Markets back in the red today for the most part. Modest losses, as we just saw, reversing some earlier gains. This is as traders await fresh U.S. inflation data following the release of lighter than expected producer price index from this morning. CPI is tomorrow. For a closer look at today's markets and what he likes and what he doesn't, we're joined by Patrick Horan, principal at Agilith Capital. Patrick, good to see you. How are you, sir?
Good to be back on the air with you, Mark.
Excellent. Yeah, you too. We bumped into each other recently through happenstance, and here we are on television doing the same thing. So
there you go.
You understand, I understand that the last 3 years you basically have had the same investment strategy, and you're looking for cyclical value. Why is that?
Yeah, we think that the growth phenomena is very long in the tooth here. We think it started with ultra low interest rates. And I would even argue dangerously low interest rates. And it really caused a crowd herding phenomena that hasn't really flushed itself out, hasn't even come close yet. And we think the benefactor of that flushing out will be the value in cyclical stocks. They're the ones that typically are the most geared towards inflation. And inflation and productivity growth are the two big surprises over the past couple of years. We think those are the big benefactors of stocks that remain today pretty cheap. And we think you should be holding them. And we think it's probably, when I say long term, 5+ years.
Now, you're looking at avoiding defensive such as staples, REITs, utilities as well. Is this primarily because of rising bond yields?
That's right. Yeah, they tend not to have the ability to gear their revenues to GDP growth, nominal GDP growth. So they lose a little bit by inflation. They tend not to have the productivity improvements. They're effectively counter-cyclical stocks, which was good when interest rates were low and people assumed that the bond market knew something the equity market didn't. And so therefore there was a fear factor, therefore you should buy these and hold these. Well, they were held to what I would suggest were growth multiple, heavily premium to the indexes on a multiple basis. And we think just over time, they are not going to be able to grow their way out of, or even really keep up to nominal GDP. A lot of them, not all of them, but a lot of them have very high leverage ratios, financial leverage ratios. And the higher that the long-term bonds climb, the more they're going to have to increase their return on assets to cover that leverage ratio. All that said, that if they can't cover it, it's going to come out in the equity valuation. So we think the combination of very rich values for the defensive areas and their higher gearing ratio to leverage, financial leverage that is, will make them underperformers in a stock portfolio.
Patrick, you are looking around in underappreciated areas, which you talked about off the top, and you've got some names for us here. Let's roll through some of these and you can tell us why you like them. How about Manulife to start?
Yeah, we like Manulife. I think people forget that in the 60s, the late 60s, when you had a very similar phenomenon of what we have now, which basically, 15 years of deflation, followed by rapid increase in inflation, insurance companies were considered growth stocks. And right now, we think Manulife and some of the other insurance companies, life insurance companies, are growth stocks, but yet you're buying them here at value stocks. So Manulife is probably one of the best large cap financial companies in terms of performance anyway over the past couple of years. We think it has a lot more to go, and I don't think we're being greedy here. They continue to buy their stock. They continue to raise their dividend, and expectations have been ratcheted up by management, not by the street. So we like that. We think they're still cheap. and they benefit handsomely in a steepening yield curve, which is what's happening right now.
All right, Patrick, if you could, maybe 30 seconds each on precision drilling and Enerflex, two others you like.
Yeah, so people kind of forget or have to kind of focus in. What Trump really wants to do is insulate himself from the rest of the world and create a North American barrier. Once upon a time where our oil and gas companies competed on a world scale and were priced off the world market, it was cyclical. There were geopolitical, there was lots of supply uncertainty. There was, there were other issues, but if we think that the oil and gas sector is changing from a cyclical industry to more of a factory-like industry, very steady production, and it's steady. The world is using it. North America needs it to insulate themselves from the rest of the geopolitical, and I think Trump is going to embrace it. So we like the companies that add to productivity to the oil patch. We think the market. These stocks are very cheap from a cash flow. They're some of the cheapest. However, we think they deserve probably a market multiple, which probably means there's somewhere around a double here.
And just lastly here, Patrick, Manulife, Precision Drilling, and Enerflex, disclosure, if you could, please. You own those personally and for clients?
We only own all of our wealth is in our funds, and our funds hold those stocks.
Okay.